There was a moment last Friday night that didn't make a lot of noise, but it should have made people uncomfortable. Silver was sold hard. Not during active trading hours, not with headlines or panic, just quietly pushed down when liquidity was thin, the way it's been done for decades. If you've watched this market long enough, you know that move. Usually, that's where the story ends. Price drops, sentiment cools, and everyone tells you the rally was overextended. But this time, something strange happened. Within hours, not days, not weeks, silver was right back where it started. Almost as if the selling hadn't mattered. Almost as if the market itself refused to stay down. That's not how silver used to behave. In 1980, selling crushed it. In 2011, selling crushed it again. Back then, paper pressure worked. Charts rolled over, confidence broke, and gravity did the rest. This move felt different. Less like a market reacting, and more like a system quietly ignoring an instruction. I remember watching that bounce and thinking, this doesn't feel like momentum. It doesn't even feel like speculation anymore. It feels like something underneath the price isn't cooperating. And when a market stops responding the way history says it should, the question isn't where the price goes next. The question is, what is it actually responding to now? This episode isn't really about where silver is going next. It's about what kind of market silver has quietly become. Most conversations around silver still revolve around price targets, resistance levels, and whether a move is overbought. That way of thinking assumes the market is still doing what it has always done, discovering price through paper, leverage, and confidence. But what we're watching now doesn't fit that framework very well. What's unfolding looks less like a speculative rally and more like a structural handoff. A shift from a market dominated by contracts and promises to one increasingly constrained by physical limits. Not overnight, not dramatically, but persistently enough that old tools are starting to misfire. This isn't a call to predict a number or chase momentum. It's an attempt to understand a deeper transition, from price being managed to price being enforced by availability. And once a market crosses that line, it doesn't matter how convincing the charts look, because at that point, silver is no longer behaving like a paper asset. It's behaving like a shortage. There's a part of this story that almost never gets discussed clearly, because it sits in an uncomfortable space between history and assumption. When people look at silver today, they instinctively reach for familiar comparisons. They point to 1980. They point to 2011. Two explosive moves. Two failures. Two reminders. They say that silver always gives it back. And on the surface, that logic feels reasonable. Those charts are burned into memory. But here's the part that quietly gets skipped. In both of those episodes, silver didn't fall because demand disappeared. It fell because paper selling overwhelmed physical reality. In 1980, a handful of players drove the price up, and the market responded by flooding the system with contracts. In 2011, liquidity was still deep enough that paper could be created faster than metal needed to exist. Selling pressure worked because the system had room to absorb it. That assumption, that selling will always work, is deeply ingrained. What's different now is not the price level. It's the reaction function. We're seeing repeated attempts to push silver down using the same playbook, and the market simply doesn't stay there. It slips, pauses, and then snaps back. Not with excitement, not with euphoria, almost mechanically. That's the uncomfortable part. If paper still had full control, price would linger lower. Confidence would weaken. Momentum traders would flip. That's how it's always gone. Instead, we're watching selling attempts get erased in hours, sometimes faster than news can catch up. If you've ever watched a system where inputs stop producing expected outputs, you know the feeling. It's subtle, but it sticks with you. Something in the machinery isn't responding the way it used to. And once that question forms, once you start wondering why selling doesn't stick, you're reforced to look beyond charts. You're forced to ask how this market is actually wired underneath. To make sense of what's happening, it helps to stop thinking of silver as a single market and start seeing it as a junction point. Silver isn't just a precious metal sitting in vaults waiting for investors to argue about price. It sits quietly at the intersection of several systems that usually don't collide all at once. Finance is one of them, of course, futures, ETFs, hedging, leverage. But layered on top of that is industry. And layered on top of that is energy, technology, and defense. Most of the time, those worlds stay politely out of each other's way. Investment demand comes and goes. Industrial demand hums along in the background. The paper market smooths everything out, absorbing pressure so nothing feels urgent. That balance is what people mistake for stability. What's different now is that multiple systems are leaning on silver at the same time, and none of them are particularly flexible. Solar panels don't care about price momentum. Electric vehicles don't wait for RSI to cool off. Defense contracts don't get canceled because a chart looks stretched. Each of these systems pulls metal out of the same physical pipeline, quietly, consistently. And when that happens, the market doesn't break all at once. It starts to skew. You don't see it in headlines first. You see it in small things. Delivery timelines that stretch. Premiums that don't come back down. Selling pressure that works for an hour and then just fades. It's not dramatic. It's cumulative. This is why looking at silver purely through a financial lens feels incomplete. The price isn't just responding to traders. It's responding to competing claims on the same limited material. Silver isn't scarce in theory. On paper, it's abundant. But scarcity isn't created by geology alone. It's created when too many systems try to draw from the same source at the same time. Once you start seeing silver as a shared dependency rather than a speculative instrument, the behavior makes more sense. And that's where the real breakdown begins. Once you step back from the price and start watching the structure, the pieces line up in a way that's hard to ignore. Not as a single dramatic event, but as a series of pressures that have been building quietly for years. The first pressure is simple, but persistent: deficits that never went away. For roughly 5 consecutive years, global silver production has failed to meet total demand. Not by a dramatic, headline-grabbing margin in any single year, but enough that each shortfall had to be filled somehow. And that somehow wasn't new mines coming online. It wasn't a surge in recycling. It was paper, futures contracts, forwards, unallocated accounts, promises that the metal existed somewhere, available if needed. In the short term, that works. Markets are built on trust, and as long as participants are willing to roll contracts instead of asking for delivery, deficits can be smoothed over. 1 year of that is manageable. 2 years starts to feel uncomfortable. 5 years turns a workaround into a habit. And habits in markets have a way of becoming invisible, right up until they stop working. That leads directly to the second pressure, the size of the paper market itself. In major trading hubs like London and New York, the outstanding volume of silver contracts has grown to levels that no longer resemble the underlying physical inventory. This isn't controversial. It's how modern commodity markets function. A large paper market allows liquidity, hedging, and price discovery. But it also assumes that only a small fraction of participants will ever ask for the actual metal. That assumption is the hinge everything swings on. Because when outstanding claims become too large relative to deliverable supply, the market stops being a price-setting mechanism and starts becoming a confidence system. It works not because the metal is there for everyone, but because everyone agrees not to check at the same time. As long as that agreement holds, paper can dominate price. When it starts to fray, behavior changes. And behavior has been changing. The third pressure comes from where demand is coming from now. In past cycles, silver demand was heavily financial. It surged when investors chased inflation hedges and retreated when sentiment turned. That made it volatile, but also predictable. This time, a growing share of demand isn't optional or emotional. It's industrial. Solar energy alone has reshaped the baseline. Each panel uses small amounts of silver, but at scale those small amounts add up. Electric vehicles introduce another layer: power electronics, charging infrastructure, efficiency requirements that don't have easy substitutes. Add to that the quiet but relentless pull from defense systems, where silver's conductivity and reliability aren't negotiable. What matters here isn't just that demand is higher. It's that this demand doesn't respond quickly to price signals. A hedge fund can step away when volatility spikes. A manufacturer can't redesign a production line overnight because silver got expensive. These systems plan years ahead, and once contracts are signed, metal has to be sourced regardless of short-term price swings. This is where the old comparison to past silver spikes starts to break down. In 1980 and 2011, demand could retreat. Today, a large portion of it can't. The fourth pressure shows up in market behavior itself, the fading effectiveness of selling pressure. For decades, one of the defining characteristics of silver was how easily it could be pushed down. Large sell orders during thin trading hours would cascade through the market, trigger stops, and shift sentiment. The mechanics were well understood. Price went down, confidence followed, and rallies burned out. Lately, that sequence has been breaking. We've seen repeated attempts to knock silver lower using familiar tactics. The initial move still happens. Price dips. Algorithms react. But instead of lingering lower and building on that weakness, the market snaps back. Not with excitement or news-driven buying, but with steady absorption. It's as if the selling finds fewer willing counterparts than it used to. That doesn't mean manipulation disappeared. It means its impact window has narrowed. When physical demand is strong enough, paper selling can still create momentary distortions, but it can't sustain them. The market clears faster. Weak hands get shaken out quickly, and then the underlying pull reasserts itself. That's not a bullish signal in the usual sense. It's a structural one. The fifth pressure ties all of this together: the growing importance of delivery. In a healthy paper market, most participants never intend to take possession. Contracts are financial instruments, not claims on boxes in a vault. But when trust erodes, even slightly, intentions change. Some participants start asking different questions. Where's the metal? How long does delivery take? What happens if too many people ask at once? You don't need a mass rush for delivery to change the market. You just need enough participants to care. Even a small shift in behavior can strain a system that's optimized for rollover, not fulfillment. Delivery times extend. Premiums detach from spot prices. Physical markets begin to speak a slightly different language than paper ones. This is where silver starts behaving less like a trade and more like a bottleneck. And it's important to be clear about what this does not mean. It doesn't mean the market is about to collapse tomorrow. It doesn't mean every contract will fail. Systems like this are remarkably resilient until they aren't. What it does mean is that the margin for error has shrunk. The buffer that once absorbed shocks has been thinned by years of deficit, leverage, and rising non-negotiable demand. At this point, price becomes secondary. The real story is about priority. Who gets metal when supply is tight? Industrial users with contracts? Investors with allocated holdings? Financial players rolling paper positions? The market can juggle those priorities as long as trust holds. When trust weakens, even slightly, priorities harden. That's when you start seeing a market transition from one governed by expectations to one governed by constraints. And once constraints start setting the rules, the surface-level debate about whether silver is overbought misses the point entirely. The question isn't whether price has moved too far, too fast. It's whether the system underneath still has the flexibility it used to. Because if it doesn't, then what looks like volatility on a chart may actually be the market adjusting to a new set of limits. And that's the moment where the story quietly flips. At this point, it's tempting to say the story is about price, how high silver has gone, how fast it's moved, and where it might run into trouble next. That's the instinct most of us have, because price is visible. It's clean. It gives us something to point at. But that framing misses what's actually happening. The price isn't leading this move. It's reacting to it. What we re-watching ISNT silver discovering a new valuation because traders suddenly changed their minds. It's silver adjusting to pressure that's been building underneath the surface for years. Deficits didn't start last month. Industrial demand didn't appear overnight. Paper leverage didn't suddenly become excessive. All of that was already there. The difference now is that the system's ability to absorb those pressures has weakened. That's the turn most people don't see. When a market is functioning normally, price acts like a steering wheel. It guides behavior. Higher prices discourage demand, attract supply, and cool things down. But when supply can't respond quickly and demand isn't discretionary, price stops steering. It starts flashing warnings instead. In that context, rising prices aren't the cause of instability. They read a signal that stability is already eroding. They're telling you the market is struggling to reconcile competing claims on a limited resource. Not loudly, not dramatically, just persistently enough that the old balance doesn't quite hold. This is why the usual debates about whether silver is too expensive feel oddly irrelevant. Expensive relative to what? To last year's price? To a model built for a different kind of market? Once you recognize that price is responding rather than driving, the narrative changes. The rally stops looking like speculation getting ahead of itself and starts looking like a system adjusting, imperfectly, to constraints it can no longer ignore. And that shift in perspective sets the stage for the next question. How do you remember something like this well enough not to misread it again? A useful way to think about this isn't through charts or ratios, but through how systems behave under quiet stress. Imagine a large stadium being filled with water, not by a flood, not by a burst pipe, just by a single drop that doubles every minute. For most of the process, nothing looks dramatic. 40 minutes in, the stadium still looks mostly empty. You could walk through it and convince yourself there's plenty of room left. That's the deceptive part. The system feels stable right up until the final moments. Then the last few minutes arrive, and everything changes faster than intuition can keep up with. Markets under constraint behave the same way. They don't announce the moment they've crossed a threshold. They absorb pressure, adapt, and compensate until they can't. The warning signs aren't spectacular. They're subtle. Delays instead of shortages, premiums instead of price spikes, selling that works briefly and then doesn't. Another way to picture it is a bridge designed to carry a certain weight. Add one more truck, and nothing happens. Add another, and still nothing happens. The structure doesn't collapse gradually. It holds, flexes, and then fails when a limit is exceeded. Not because of a single truck, but because of accumulated load. Silver right now feels less like a market in motion and more like a system nearing capacity. Not breaking, not failing, just operating with less margin than before. And when systems reach that stage, the most dangerous assumption you can make is that yesterday's behavior will continue unchanged. Which is why the next part of this story is in TA prediction. It is a set of conditions that matter far more than forecasts. This is where it's important to slow down and be precise, because nothing in markets moves in straight lines, and nothing here is guaranteed. What we're describing isn't a prophecy. It's a set of conditional risks that only materialize if certain pressures continue to build. But those conditions are no longer abstract. If physical delivery becomes a priority for more participants, not everyone, just more than before, stress begins to surface in places that paper markets aren't designed to handle. Delivery timelines stretch. Contract terms quietly change. The cost of immediacy shows up not in headlines, but in premiums and exceptions. If confidence in intermediaries weakens, even slightly, behavior shifts again. Investors don't have to panic to change outcomes. They just have to start asking practical questions. Where is the metal held? Is it allocated? What happens under strain? Systems built on rollover don't fail because everyone leaves. They fail because enough people stop assuming they never will. Another condition lies outside the silver market entirely. In periods of financial stress, governments tend to prioritize control over efficiency. If capital controls tighten, or if access to certain financial instruments becomes restricted, the distinction between paper exposure and physical ownership matters more than it did before. Not because paper assets vanish, but because their rules change. None of this happens overnight, and none of it has to happen everywhere at once. But these are the kinds of pressures that compound quietly. Each on its own is manageable. Together, they begin to limit the system's flexibility. The key point isn't that a failure must occur. It's that the margin for surprise has narrowed. The system has less room to absorb shocks without changing its behavior. And when margins shrink, paying attention to signals becomes far more important than listening to predictions. When systems enter this kind of phase, the most useful question isn't "what should I do?" It's "what should I be watching?" Signals don't give instructions. They reduce the chance of being surprised. One of the first things to pay attention to is the relationship between spot prices and physical premiums. In a purely paper-driven market, premiums rise and fall quickly. They spike during moments of excitement and fade just as fast. When premiums stay elevated even after price pulls back, it suggests something else is at work. Not urgency, persistence. Another signal lives in delivery timelines. Most people never notice them because, in normal conditions, they don't matter. But when lead times stretch quietly from weeks to months, it tells you the physical pipeline is tighter than the screen price implies. That's not a crisis signal. It's a friction signal. Then there's backwardation, especially when it lingers. In theory, futures prices should reward time and storage. When near-term delivery becomes more expensive than later delivery for extended periods, it reflects a preference for metal now rather than promises later. That preference doesn't emerge without reason. You can also watch how financial products subtly change their language. Small adjustments to prospectuses, redemption rules, or settlement terms often appear long before stress becomes obvious. These aren't headlines. They're footnotes, and footnotes tend to matter most near inflection points. Finally, pay attention to who is accumulating quietly, not the loud buyers, but the steady ones. Industrial users securing supply ahead of schedule. Institutions shifting from synthetic exposure to allocated forms. Behavior changes like these rarely announce themselves, but they leave patterns. None of these signals tell you where silver is going tomorrow. They tell you how the system is feeling today. And once you start reading the system instead of the price, a more personal question naturally follows. At some point, the analysis stops being about silver and starts turning inward. Because if what we're watching is a quiet shift from promises to constraints, from paper flexibility to physical priority, then the real issue isn't whether silver goes higher next month. It's how we, as observers and participants, define safety in systems that are under strain. For years, we've been trained to think in terms of access. As long as something can be bought, sold, or rolled over, it feels reliable. Ownership becomes abstract. Exposure feels like possession. Most of the time, that works. It works so well that we forget it's an assumption. But when systems tighten, assumptions get tested. Not dramatically, not all at once. They're tested in small ways, a rule change here, a delay there, a condition that didn't exist before. And those small changes force uncomfortable questions. What does it mean to own something in a market built on intermediaries? How much of our confidence rests on liquidity versus availability? And at what point does efficiency quietly give way to priority? There isn't a single right answer to those questions. I don't have one. What matters is noticing when they start to matter again. So the real question isn't whether silver is overbought or oversold. It's this: if markets are slowly shifting from trust-based systems to constraint-based ones, how does that change the way you think about risk and safety? If this way of looking at markets resonates with you, not as a place to chase moves, but as a system shaped by incentives, constraints, and quiet shifts, then you're exactly who this channel is for. Here, we don't try to predict tomorrow's price or sell certainty where none exists. We focus on how money actually behaves under stress, how power flows through financial systems, and how real assets start to matter when assumptions get tested. Silver is just one lens. The bigger story is always about structure. If you want to keep exploring that story, make sure you're subscribed. New episodes dive into paper versus physical markets, capital controls, historical breakdowns of monetary systems, and the signals that tend to appear before headlines do. And if this episode made you pause, even briefly, you might want to watch the next one, where we look at how paper markets respond when delivery starts to matter more than liquidity. Subscribe, stay curious, and keep watching the system, not just the screen.